Hey there, YouTube. So last week I showed you several candidates that I was going to enter some positions on that were reporting earnings, and we were going to take advantage of implied volatility. I'm going to do the same thing this week. We'll go through several candidates. Last week we had a 100% success rate. We're hoping for the same again next week. We earned 7.4% last week. So with that, if you like these videos, feel free to subscribe. Love doing them. So let me know that you like them. And with that, let's jump in. All right, so last week I gave you the entire list of candidates. We looked at all of these. Now, Monday morning when the market opened, the yellow highlighted ones are the ones that I actually entered. There were some things that I didn't like about PayPal when it opened. Maybe the premium wasn't good enough or had moved beyond what I wanted, so I did not enter those. So these were the ones that I was able to execute at the price that I was looking for. Now, last week we showed you that these were some of the strike prices that we would enter. And as you can tell, some of these vary, some of them are the same, but I switched it out just a little bit. And that was based on what the price was that morning. I looked at the expected move for the week, and then I entered my position lower than the expected move. None of these were entered as naked puts, meaning I didn't just sell a put, I sold a put and then bought a put so that I could protect my downside risk. That actually gave me a little bit more return than what my software was showing here. So here's the ROI, assuming that you sell it as a naked put. When you enter it as a spread and you buy the put below what it recommends, well, then you can increase your return slightly. So that's what I did. This is the margin that I used per contract. This was per spread. And so if you see, the minimum requirement last week was $4,700. Now, I entered several of these contracts, but you can kind of get an idea. If you were just to do one of these, that's all that was required was $4,700. So with that $4,700, each one of these I received a credit. So $83 here, $15 here, $67 here, so on and so forth, and that gave me $348 worth of premium that I'm going to get paid to take on the risk. And then my ROI, because of that, because I had a 100% success rate, was 7.4%. So I made 7.4% in a week. If you were to annualize that, it would be a pretty significant number. Now, a couple of these, as the week went on, some of these stocks actually went really close to the striking price, which is why I choose the expected move and then some. That way I can give myself a little bit of buffer. Because this, for example, UPS was trading around $99. Spotify was trading around $7.20. But look at the strike where I selected. I was selecting way out of the money. And then that way I've got several dollars worth of room to work with, right? Same thing with the Robinhood. It was recommending the strike was $96. Here it was 105. It actually, I think, opened up and it got up to 109 Monday morning. So I ended up entering a 101.96 spread instead of what it recommended here. And that was as of Friday, because I'm doing these over the weekend and I have to look at the prices Monday morning and then make a determination and go from there. Bottom line, we had a very good week. Let me show you what some of those look like this week and where I put those positions in. So here's Coinbase. Monday morning, we're up here around that 430 range. I put my strike all the way down to 390. This yellow line represents the put where I entered, and then this is the second put that I bought. So my risk was only here. I received 52 cents. So that means my break even, had I got exercised, it was put to me, my break even would have been 389.48. So when it started dancing around here, like right after I entered this, isn't this how the stock market works? Sometimes you enter a position and then it goes against you right away. So right away, I became negative on this because later that day, it dropped quite a bit. And so this position became negative. It was pretty much negative all week, but I stayed with it. And I knew that my expected move as the Monday morning was less than 390. I think my expected move was somewhere around 400. So I went a little bit below the expected move, sold my put there, bought a put here for downside insurance. So it teetered around here. At this point, there's a couple of different rules of thumb. Some people believe if you're doing these put spreads that you could go ahead and close it. Once it hits your striking price, go ahead and get out of it, minimize your risk, cover it. and that might have been a $200 loss. I didn't want to do that. I actually decided, let's just ride it through and it might pop up. And it did. And then on Friday, it went right below it again. And I thought, well, this would be a good opportunity to show how you can work out of a position. I was going to wait to see if I got exercised. And then I was going to show you in this week's video how I would work out of it. And that's basically take it, because I would have gotten the 100 shares put to me. And then I would have ended up selling calls and buying puts because I knew earnings was coming up. So I would have probably bought a put for the downside protection in case Coinbase tanked. I would have bought a put, but I would also sold a call to help pay for that put. And then I would have given myself some range of profitability in case Coinbase decides to go up. So I was going to show you how to work that, but I didn't get the opportunity. Look at this. It expired just outside of my range. Beautiful, actually, 391, and I had sold a 390 put. So that was pretty cool. UPS, let's take a look at this one. Monday morning, opened up. It was around $99. The recommendation was to go, UPS doesn't move much, so the recommendation wasn't too far south of that. It was, 97, 96, 97. Let's see. Yeah, the recommendation was 96. So this was actually here. And then right away, and then a 94 put is what I bought down to buy myself some downside protection. So the risk was $200 per contract, less the premium that I received. And the premium I received on this was $15. So 15 cents, really not that much, but it was enough to give me a decent return. I was willing to accept. That would have put my break even at 95.85 because of the 15 cents that I received in credit. But as you can see, I never got the opportunity, never even got close. It shot right up right away, and I became profitable right away and then stayed there all week. Look at Robinhood. Now this one, same kind of thing. Monday morning, we opened up. I set my price at the expected move, and then a little south of that. Expected move was somewhere around $6 for the week, so I set it down to $9. And look at that. It went right to it later on Tuesday. Actually clipped past it. This was another one. I was thinking, I'll just wait and see if I can show you how to work your way out in case you get assigned. And it just teetered around there all week long. And then on Thursday, Friday, it popped back up and it expired worthless. And that means I was able to keep the full credit. Same thing with Meta. Here it is, Monday morning, opened up, sold a 685 call put, and bought one. So my risk on this case was $1,000 because it's a $10 spread. And the price shot up and I was profitable pretty much all week on Meta. So those are just a few of the examples. And these are the ones that I entered. Risking $4,700, made $348, gave me a 7.4% return. Not bad. I'll take that all day long. Let's look at what's coming up this week. So my software went out and scanned the universe again, said, go find me everything that's reporting earnings and tell me which ones have the highest volatility. Remember, before earnings, volatility goes up because people are protecting themselves usually from the downside. That's where we come in because we're the option seller. We're selling that risk. We're selling the insurance to protect their risk. So this is what it's recommending. We got Palantir coming up week after next. We are not trading earnings for next week. We did that last week. We're not going to do that because we can't get out of it by Friday. And these options all expire on a Friday. So we're going to pick the following week's earnings. So Palantir, Arista Networks, AMD, looks like Uber, Shopify, Disney, several of these that I picked based on their volatility. My software picked it based on the volatility, comes up with the recommended ROI, the recommended strike price, and this is as of Friday's close. So Monday morning, we'll have to reevaluate, and it may be slightly higher, maybe slightly lower. I'll probably enter these as all put spreads again. And then I'll highlight it. We'll go through the same exact exercise next week. All right, so let's see what is coming up the following week. This is where my scanner goes out and evaluates these guys, along with some others, and then comes up with some recommendations based on volatility. And so you got several reporting the week after. These are the ones that I'm interested in trading. We just saw that list, so you can get to this. on sector spiders and earnings calendar. One last thing before I let you run, look at some of the candidates. So I've already pulled some of these up. We're looking at Vistra. This is the historical volatility. The white line is the implied volatility. This is what I'm selling. The implied volatility is higher on Vistra these last couple of weeks. So this is all I'm interested in. If the white line was below the red line, wouldn't even trade it, because my thesis is that most of the time stocks will go back to their historical, where implied is where people are there's a little bit of fear in there, so they're paying a little bit more, and that's what makes it great for me as an option seller. There's Uber. Take a look at this. Implied volatility way over historical, 43% compared to 30%. Let's take a look at Palantir. Yep, 61%. That makes those options pretty expensive, so people are paying more as an option seller. It's fantastic for me because they're willing to pay more. And historical is only 42%. So I'm going to use all my calculations based on implied volatility, which is what people are expecting, and then I'm going to find that expected move, and I'm going to go south of that and sell my puts. One other thing, take a look at Palantir. So this is 3 weeks ago. This is called volatility skew. This yellow line represents the prices of yesterday. I should say the implied volatility as of yesterday, which you can infer that the prices are going to be more expensive. And then look at this darker yellow line. This is 3 weeks ago. So 3 weeks ago, for this strike, it was cheaper from a volatility perspective. Because earnings are coming up, people are beginning to pay more. And it's almost that way on every single one of these. Let's go back to, you can barely see that dark yellow line. Let's see if I can blow that up. There's the dark yellow line from 3 weeks ago. The bright yellow line, volatility is more expensive. People are expecting bigger moves. Makes premiums more expensive. Let's look at Shopify. Come on, there's Shopify. Look at Shopify. The volatility as of yesterday, implied volatility, is way higher than it was 3 weeks ago, which means, again, I'm going to get more money on my premiums than if I would have done this back here. Now, there's some time decay and all that, but from a volatility perspective, prices are much more juicy. Again, I'm going to get out of all of these before earnings so that I do not have any earnings risk. So the goal is set these up for next Friday, not the week after. If I set these up for the week after, it's too late. I am going into earnings risk. I do not want that. I want out by Friday. So if you like this video, please hit the subscribe button. Send me a couple of comments. Let me know you like this, and happy trading. Good luck. Again, this is not investment advice. Do your own research, and happy trading. Thanks.